give money and also give interest rates to somebody else. So I think we have to accept the fact that these are really abnormal times when 90% of the world has negative interest rates. And therefore, to expect that this will not have a consequence is to live in a la-la land.
Yeah. Rajesh, when the startup and venture capital culture is, or venture culture is growing, and if such a thing happens, as we discussed, what do you think will be the consequences?
I think I already touched upon this, but I think there's going to be a distinction from what has happened in the past to now. It's interesting, in the late 90s, the shock was from the public markets crashing. If you look at the companies which were valued over $100 million, rarely was there a private company at that time that did not go public. If you look at the number of billion-dollar companies in those 3-year period, which remained private, combined, 99, 2000, 2001 were 6 companies. We have nearly 85 companies today which are private, and they are valued more than $1 billion. There could be a couple of different reasons, right? One, companies are afraid to test the markets, especially these tech companies, without any decent revenue or profitability models, because the public market investors are a lot more cautious this time around compared to the late 90s. The shock in a public market environment is usually very swift. Regardless of, there is some liquidity. Of course, on the way down, you're selling, but NASDAQ would come down from 5,000 to 1,100 in a span of 9 months, 12 months. The correction is swift. It happens within a year. Today, we could already be in a bubble, and the bubble could have burst. You wouldn't even know. It's going to be a lot slower. At least that's what I think. Because most of these highly valued companies are private companies. And there could be trouble, and you wouldn't even know. There's no liquidity to get out. Even if you're an insider of one of these companies, you just don't know how to get out, unlike the public market. So the correction, you may not see a dramatic effect like the .com, where the whole world knew there is a bust. It could be gradual. It could take 2, 3, 4 years before everything corrects itself. So one doesn't have to worry like the late 90s that the tap is going to be closed overnight, like it happened then. It's going to be gradual. So you as an entrepreneur, you need to focus on fundamentals and build fundamentally sound companies. Focus on business models where the consumer or the businesses treat your product or service as a must-have rather than good to have. Good to have companies tend to disappear in tough times. And eventually, these things, the normalcy will come back. Markets are efficient. For most often they're efficient, and in the long run they tend to be efficient, so they come back to normalcy. Your job is to make sure that you're fundamentally sound business plan. You don't get carried away with all these abnormal couple of year volatility in funding and craziness, and money can be raised for good companies. So stay the course. I would say I would not worry about the shock we felt in 99 or 2000 to be felt this time. It's going to be a lot more gradual. Companies will slowly auto-correct themselves in terms of the business models and profitability models.
So it's a relief when you say that good companies will get funded. Huh?
Yes. See, the good companies are
getting a little depressed with all the
one thing, now, good companies will get funded this time around. That was not the case in the late 90s. Okay. When the shock is so much and happens overnight, good companies were not getting funded then. Now, I'm a lot more optimistic that good companies will get funded regardless of a shock coming this time.
So Raj, I have a sidecar anecdote to that. I mean, Rajesh is looking at it from the quant point of view, and if I look at it from the psychological point of view, maybe 5-10 years ago, the relationship between an entrepreneur and a venture capitalist in India, in Bombay, would be one of pretty much, venture capitalists, you're the king. Yesterday, we all know there was a letter from the CEO of housing.com to Sequoia saying, go die, you mother F. I hope you die. I hope your fund dies. And this is from a 22-year-old who got funded 700 crores by a bunch of people, right? So I think there's been a swing in the pendulum. I think the swing will come back to somewhere more moderate in terms of relationship, where it was at one point, the investor was a king, to one point where the entrepreneur says F you to the investor. I think we'll come back to a point again where there will be some humility on both sides of this fence, right? We've swung to a point where, like we said, essentially revenue-less models are being given. I mean, there's a friend of mine, I won't name him, you guys will know the context. He was offered $1 billion valuation. And he came and looked at the others getting $1 billion valuation. And he said, screw you, I'm not going to do that. I'm worth $2 billion. He held out. Sure enough, a Japanese company came a few months ago and gave him a $2 billion valuation. Why? He's profitable. He said, I don't need the money. I just wanted to show the world that I got a $2 billion valuation. These are dangerous times when that happens. I mean, at this point, I think we have to come back to a little bit of sanity in the middle. That's okay. The world will keep swinging. We'll go overcorrect at this end. We will overcorrect at that end. But I do start seeing a swing back from an entrepreneur's point of view, where it will not necessarily pay for you to go and take the stand that investors are a-holes or mother Fs or whatever it is that you're able to do. And neither will it be other way. It's not going to be a way where a VC says, okay, entrepreneur, you're under my thumb. It will come back to, I hope, more sensibility.
Great. Now, Vish, given what Rajesh is saying and the state of the equity markets, there's a feeling that, look, now the valuations are high, I must get good valuations. What do you think the reality in 2015-16, given that the Sensex is now 25, 28, 30, or whatever it is, it's in the high 20s. How will it impact valuations of businesses?
So I think, Raj, regardless of the valuations, I think one trend, I'm personally actually very...
You're not audible.
One trend, regardless of the valuations that come about in the next couple of years, one trend I'm actually very positively and very excited about is the fact that there are a lot more entrepreneurs that are taking risks and building companies. So back in the 90s when I was graduating, there was a huge rush to, I think there were 330 people in my class at IIT Delhi and 300 of us went abroad because that was the thing to do. You would go out, work at a consulting firm or a bank or doing some sort of relatively risk-averse job. I think people now coming out, whether it's housing or whether it's a bunch of these other companies, a lot of these models may or may not make sense, but I think the risk appetite of the average young Indian has actually gone up tremendously. And because that's the sort of, look at the post-Manmohan Singh generation, people who are born after 1991 haven't really seen that state of India where there was supply side constraint, there was no telephone lines, you had to wait 6 months to get an MTLN connection, there was no, even gas connections were difficult to get. So that side of India, a lot of 20-year-olds haven't even seen it because they were born after that. So their ability to take risk is much higher. And there was such a capital constraint in the 90s that's why you see all these conglomerates, whether it's the Birlas or the Reliances or Ambanis, etc. All of them have Mahindra, they have so many different divisions doing different things. And that happens in the evolution, even in the US and Europe. There were a lot of conglomerates in the early 1900s. But now there are essentially pure play companies in each sector. So in India, to get that entrepreneurial culture, part of the problem that we face is that there aren't enough good promoters to back. And there's enough capital around the country, and you had some statistics around $80 billion invested. There is 100 billion more waiting to come in, provided we can find good promoters to back, but we are not able to find that. So this culture of people taking risk and building companies, learning by failure or otherwise how to be good entrepreneurs, I think is a good trend. And 5-10 years from now, we will certainly see a much more thriving ecosystem of entrepreneurs, companies, etc. So overall, it's a good thing for the market. The fact that somebody who perceives he can build a company in 2 years can possibly become worth 100 million or even more will encourage this entrepreneurial culture. Now, a lot of this will not work out, right? It will not work out and it will end badly for a lot of people, but at least you've got the ecosystem thriving. And there is that feeling that you don't have to be in Silicon Valley to build $1 billion company. You can be in Bangalore or Mumbai.
So what you're telling the audience is that there is an entrepreneurial culture developing this country. There'll be many more entrepreneurs who are prepared to take risks and build wealth for themselves and for the others. But Rajesh, do you think there'll be enough money backing, given Sridhar's presentation, which showed that a lot of money is stuck? Only the last 3 years investments have really come back, but the old ones are stuck. What will the view of LPs be when it comes to funding, putting in money into funds like yours and everybody else's in this country, which in turn will fund the growing entrepreneurship which Vish is talking about? Do you think there'll be that appetite given these stark numbers, money stuck, exits difficult?
Yeah, that's one of the questions we get asked often by our investors, which is India and exits, age-old question, and we're still not able to really solve that puzzle. But regardless of the exits, we are still raising a lot of money into India, and last year and this year, I think we're going to raise a record number of funds, and fund sizes are in fact expanding, if not doubling, for most funds. So the investor appetite is extremely high right now, and to what others pointed out, the US and China and India are pretty much the 3 markets where people think they can make those extremely high 4x, 5x, 6x kind of fund returns. And it is possible only in these 3 economies. And China, there are some questions going forward. Is it still on the curve to maturity, or has it already matured? Can you get abnormal returns from China? Has been a question mark over the last couple of years. And they see India as the last frontier. So they see India as the next China, and over the next decade, can you extract those kind of returns that China has been delivering over the last 10 years? So that euphoria within the investor ecosystem is still there. But having said that, that really depends on India continuing to do well. And the macro signs are great. So this year, I think we're going to raise record amount of money. Macro signs turning south, or any global effects that could indirectly affect India. It's not that this is there's a longer term view from investors that we are seeing. They're still cautious about exits, but the short term, they feel India is still a land of opportunity, and this whole exit environment, at least we're trying to convince them that this whole exit environment is going to change. It has to change. The liquidity, the kind of company that are being built, the company that are being built quickly, and the entrepreneur mindset to dilute, not only when they're private, but also going and tapping public markets, diluting. That whole mindset in India is changing, which has been a hindrance to a lot of the liquidity constraints, a lot of the liquidity issues we had in India. I think the whole mindset is changing. That's what we're trying to tell them. And hopefully, there is some truth to it. We do see entrepreneurs, new age entrepreneurs, quite different, and tapping where the public markets, the private markets quickly without fear of dilution. So the investors are buying into that story, but we still have to deliver as a country. And unless we deliver, the long term, the investment patterns have to remain what they are today. Otherwise, India without foreign money cannot really deliver on its promise.
Thank you. Quick 3-line interventions from the 3 of you. In your case, do you think, how will this impact the health of the PE sector in India? Whatever you said.
Yeah, there's going to be a lot of money raised this year, which is a good thing. We are undercapitalized as a country. I'm not so sure that our future depends necessarily on macro factors. Our future as an industry depends on how wisely we invest the money that we raise this year. If we go and invest it, continue to invest it at ridiculous valuations, 5 years from now when it's time to exit, we'll get screwed, and we're going to blight another generation of people who are raising funds at that point in time because we have invested really unwisely. So I think it is up to us and not necessarily the Modi government to figure out where the future of this industry goes.
Do you think it's all about bure promoters or ande investors?
No, I don't think so. I think it's, look, the exit point has been belabored a lot. And I think the frank answer is that out of this 80 billion, a lot of it has gone into deals that didn't make sense. Now, if you've not, for whatever reason, wrong decisions were made, right, the whole industry cannot be held hostage or accountable for that. And I think some money will be lost. Let's face it, the reason why those 6-year-old investments haven't been sold is because they're underwater. You always sell your good stuff first, and then you hope that the turds will turn around eventually. But let's face it, they won't, right? So there was a lot of money that's gone into infrastructure, into power projects, which are stuck. As a country, we cannot expect a road developer to generate 25% IRR year on year. It's just not possible. And as a balance sheet for the country, why should we want high-priced capital which expects 25% IRR to go into building roads? It cannot generate that kind of IRR over the long term. A road project or a power project can at best generate 10, 12%, and that's the cost of capital that we should be attracting for those projects, right? So it's unrealistic that some of the investments going into that space will generate your 2x, 3x, 4x type of returns. It was just probably euphoria at that point. It was belief that those asset classes can generate that kind of returns. Now, I don't think that will happen. So some of those returns out of the 80 billion will not deliver for this asset class. But there are a lot of other sectors, financial services, consumer, tech, asset-light sectors, which can and will generate those kind of returns. And those good companies in those spaces have traded very nicely and are continuing to trade nicely. So I think this myth about the big exit problem, etc., is partly some dead investments which will remain close to dead, but then, as an asset class, we have to move on and say, okay, let's move on and focus on the newer generation of investments that have been made and will get exited quite nicely.
So he says something. What do you think? How it will impact the investees?
I'll just switch hats and just as investment strategies, I would say at the end of the day, valuation and timing matter, regardless of the years of horizon you have. Because somebody who put money in, let's say, in India at 2008 January probably had to wait for about 6 years before they could see some money in nominal terms in the Indian stock market, I mean. So right now, if there is so much of capital chasing valuations, as an investee company, you just have to grab it, because I think now the ball is in your favor, and it may not come back for a long time. But the key is, I hope you have a plan as to how to deploy that money, other than just to show off the valuation. So otherwise, some fixed deposits. Yeah, maybe. Absolutely, before the rates are cut. Yeah. So right now, I think from the investor's point of view, valuation and timing matter, and therefore, even if you have a 10, 20-year horizon, you cannot ignore these fundamental aspects when it comes to investing. Yeah.
Mahesh, since you're so jumpy, let me ask you a question. Some of the money is not going to get exited. Some of it can.
It was our MBA. We paid for it.
Okay. So if you think some of it can actually be exited, what should PE firms do to actually intervene or whatever to be able to exit decently?
See, one of the things we haven't done very well as an industry is taken our companies public in India for whatever reason. Out of 5,560 companies, maybe 5 are VC funded or PE funded. That's a little silly, right? We seem to have a fear of our own stock market. We seem at the first stage to immediately say, no, we have to go to Singapore, we have to go to NASDAQ, we have to go to AIM. What's wrong with testing our own markets? Especially now, for example, I see more and more people who are, Indians who are coming up and saying, can you give me see, let's put it this way. India is a growing story. The fastest growing part of India is the new Indian economy. The sad part is no Indian investor can access the new Indian economy because there's no way. There's no vehicle for him to access the new Indian economy. Because none of these companies are going public in India, and slowly some funds are being raised out of India or partly raised out of India, right? It's crazy that, the guy, the investor who's buying stuff for his, daughter and his sons and himself on Amazon and Snapdeal and Flipkart can't buy the stock in India. So at some point, if we are an India story and we're making India-focused companies, let's go public in India. Let's make these stocks accessible to the Indian public. For whatever reason, we seem to be shying away from that. I've taken a company public out here in India and also on NASDAQ. I am very happy to take companies public in India, right? For whatever reason, there seems to be this entire thing, like you said, I'm scared of taking a company public, I think once we get over that, it'll become easier. The thing is, yes, valuations will come down because the public market is not going to support crazy valuations, right? But that's a good thing. It's healthy for everybody. It gets more money once we get 1 or 2 success stories which are public in India. It's good for everybody. More people can go public, and that's a natural way to raise money. It's a little artificial, don't you think, that all the money that is funding Indian consumer plays is coming from Mauritius? And behind Mauritius, somewhere else, somewhere in the world. Aren't we rich enough as a country to start funding our own companies? So I think we need to, it can't all be Mauritius, it can't all be Cyprus, it can't all be Singapore. We have to have our own sources of capital for our own companies, which means we have to be ready to exit earlier out here in India, which means you have to then go all the way back and say you can't make silly valuations because those valuations finally at the end are not tenable out here. Understand what the P's are or PSs are happening in India and fund according to that. It's perfectly fine.
Brilliant. Interesting, very interesting perspective. Now, would the three of you give us your response to this very quickly before we open the questions to the audience?
So you talked about the stock market and India listing it in India. See, ideally we would love all our companies to be listed in India. There's no question about it, right? I mean, at the end of the day, we are trying to serve Indian businesses and consumers. Our companies are, at least, and we would love to list it in India. But it's not as easy as one would think. I mean, the stupidest restrictions of having 20% of the stock has to be locked for 3 years from the promoter side. None of our companies will qualify, especially the tech companies. The amount of dilution that's happening before they can reach a stage where you can actually list in this country. I'm sure there are ways to get around it. I'm not saying it's impossible. There are issues. And the second thing is, of course, the Indian markets, liquidity is an issue. The number of retail investors that participate in this country is quite low. Institutional money is there. But the retail investors, which bring quite a bit of volumes and liquidity into most of the stock markets, that's lacking. So there are limitations. India is slowly improving. We will get to a stage hopefully over the next 5 years, the market liquidity will improve in the listed markets. I think I'm more concerned rather than the listed markets, the M&A activity, which has to be healthy in India. And India has this, at least the Indian businesses have this outlook in acquiring companies. They're all bottom fishing. They don't look for acquiring something to grow. They're looking for something for cheap, so that they can actually extract as much cash or profitability out of an asset that they're buying. They're not buying companies as growth vehicles that happens in the US quite a bit. So that attitude has to change. And M&A liquidity will eventually prompt, I think, the other liquidity areas like listing, etc. But M&A is, I think, the core thing where the recycling of money has to quickly happen. The small companies, big companies, they all have to participate, and that's the healthy way to provide liquidity initially. Listing because of regulatory reasons, we have some issues, but I rather see a great uptick in the M&A activity.
Vish, two-liner from you.
Yeah, so I guess my view is that actually India needs less listed companies than more. Out of the $1.6 trillion market cap that India has, the top 100 constitute 1.3 trillion of that. So the rest, there are actually 7,600 companies that are listed. That is more than the New York Stock Exchange. And a lot of this is the legacy of the past, where people were raising 2 crores, 5 crores, 10 crores in the 90s. So I guess SEBI has to really think through and delist a lot of these companies that don't really cut it. Actually first scale down before we start growing again, because as you know, there is no coverage beyond the top 200 companies. No analysts are really looking at any depth on any of these companies. So it's there has to be structural reform, but in order for us to have a thriving stock market for actually well-run companies, you first need to delist probably 3,000-4,000 of these, maybe have a smallish exchange like the AIM, which you can have small market cap companies, before we can actually have good coverage, proper well-run functioning company. In fact, you see governance levels in public companies in India are actually shockingly lower than governance level in private companies. So all of that has to fundamentally change before we'll get a thriving public market.
So thank you very much. I told the audience at the beginning that you have a brilliant panel. You can see the wide-ranging subjects on which they spoke eloquently. Now it's up to you. I'm going to turn it over to you to ask questions, because there's a lot more you can get from this panel. We've got exactly 14 minutes in which we should try and ask your questions and get answers from this panel.
Sure. Just a request that since we have a couple of more private equity investors panels out there, keep the questions to the macro that these guys have discussed, And so if you could also identify yourself and your context, that will be useful. And if you need to address it specifically to one of them, that will be fine as well.
I'll ask Sridhar also come because there may be questions to you.
So any questions?
Mention your name, ask a question, rather than give an opinion.
So I am Sumit Dhanuka from Incubate Capital. Exits has been the subject matter of discussion all through for most PVC conclaves. What fundamentally what things are changing in terms of the yesteryear entrepreneurs versus the entrepreneurs today? How do you see building to exit, which is the flavor of the day for today's entrepreneurs, as fundamentally possibly detrimental to the way they think and they do, versus the way businesses have sort of grown on and prospered, where possibly exit was not at the mind of the entrepreneur when he started off. So I think we are encountering a lot of entrepreneurs who are sort of, because of the fact that there is so much of a bubble around, they are more, as you said, so valuations, timing of exit, quick exits and things like those. So how is that sort of helping the PVC circuit? Because exit is a PVC phenomena, but from an entrepreneur's perspective, for the growth and fundamental, upliftment of such businesses, how
got the question. Now, who would like to take it? Mahesh.
So, see, there's broadly two types of entrepreneurs overseas. There's a guy who builds a company for a lifetime, and even when you exit it, you stay in the company and you continue to run it after it's public. Or there's a serial entrepreneur who builds, flips, right? We don't have too many of the second kind. It's not yet in our blood to, do something, move on, do something, move on. So that's a bit of a training. I mean, this is the first time we're training our entrepreneurs to understand that you need to move on, right? That's one. Second, it's not necessarily also a good thing. Our PVC system is imported copy-paste from the US, which means 8-year funds and 10-year funds. Which new economy company, which company in India has ever gone public in 8 or 10 years? Even a Just Dial and Make My Trip and Naukri took 11 to 17 years to exit from their startup, right? So there's something unnatural about trying to squeeze an entrepreneur to exit in 5 to 8 years. I mean, no Indian company is ever built in 5 to 8 years. So there is some artificiality out here. The third part of exit is M&A. Just to add to what Rajesh said, Indian companies are under the impression, Indian companies buy overseas startups. Overseas companies buy Indian startups. Very rarely do Indian companies buy Indian startups. Right? It's a not invented here syndrome. It's not just about cash. It's about saying, Arey, how can those 10 guys with a few lines of code be worth 50 crores? I'll put 10 guys and I'll write those lines of code, right? So we haven't yet come to a point where we have enough exits happening in the system naturally. So hence, there's a pressure. So when I work with an entrepreneur, I mean, we start right at the beginning and say, you must get used to the fact that 8 years from now, we will ask you, because you're not likely to go public, you're not likely to acquire, you're likely to be acquired. So, and when you're acquired, you're likely to move out. So we have to get people used to the idea of becoming serial entrepreneurs in India for this entire market to work. It's not easy. It's not natural to us. It's a foreign concept.
We have a question there, and then the next question here.
Hello. Yeah, my question is to Mr. Mahesh and Mr. Raju. Yes, I am Manish Turakhya. I'm from Veer Capital Management. Principally, we have been investing only in listed equities, and we manage portfolios of HNIs and NRIs and all. Since last 5-6 years, we have been participating in private equity and VC. After the proposal matures, we present to guys like you. Now, the problem we have faced in terms of liquidity of the private equity funded or VC funded company, the issue is the post-listing liquidity. Can we evolve a mechanism where a VC or a PE allocates an additional fund which acts as a market-making mechanism post-listing that acts as a buffer in case of some kind of mismatch in the pricing in the post-listed
Can you make the question
territory.
brief, please?
I understand. I mean, I understand the fact that Rajesh, maybe you can take a shot at it. See, the fact is most VC funds and PE funds don't have as part of their mandate the aim of supporting a stock price. But if you don't define yourself as a VC fund and don't define yourself as a PE fund, let's say you define yourself as a Berkshire Hathaway or whatever the hell it is, right? Then no problem. The stock goes down, you go buy more of it. Because you have a long, the other thing is your horizon of the fund. If you're a 15, 20, 25-year fund, you can do that. On an 8 to 10-year fund, you have to return the money, show your investors something, go back in the market, raise more money and come back. So you have to figure out the nature of the fund. 8, 10, 12-year fund can't do what you say. A longer period permanent capital type fund can do what you say.
The next question out here. Can someone also take charge of the mic so that it can move while the answer is coming up?
My name is Joe Raskina, Blue Leaf Software. My question is for you, Mahesh. My point is that I liked your statement very much because I've been in that situation in the past whereby I get funds and I try and I hold it off so that when I have a